Welcome back. Well, let's focus on Samhi Hotels. They've delivered their numbers. We're now joined by Ashish Jakhanwala, the MD and CEO at Samhi Hotels. Hi, Ashish. Good morning. Good to see you. And I'll tell you what, I was scouting for places to go over this weekend. It's chock-a-block, anywhere. And I'm fearing actually the drive someplace because coming back will be even more difficult. That said, tell us, how has growth been? Actually, we are almost halfway through the second quarter. First quarter looks pretty okay. July and August kept up with the momentum and things get better from here on?
Yeah. Hi, Nigel. Good to have you. Good to have me on the show. We had a very good April and June, and May, of course, because of the known reasons best known to everybody, was slightly flattish. But we've seen the momentum continue through July and August. So we actually remain fairly upbeat about the remainder of the year. As you rightly said, the demand is just not letting up, and I don't expect it to, given where India is headed. So be ready to plan your vacations well in advance, otherwise you'll keep complaining.
The momentum is as strong, you're saying, Ashish?
It's as strong.
Because in Q1, there were a lot of cancellations, obviously, right? I mean, across, not just your chain, but across.
Only in May.
Only in, yes.
Only in May. Yeah.
But you think all that has been made up and it's kind of back on track?
Yeah, so if you see, we have presented a slide in our presentation which says that April numbers were up about 13%. May was at about just 3.5-4% over last year. June went back to about 12% over last year, and we've seen that momentum continue since then. So the recovery was pretty quick after the incidents that happened in May, and we actually therefore remain quite upbeat for the rest of the year.
And bookings for the third quarter, which perhaps is the strongest for you, that is coming along nicely already?
Listen, a little early. The business, unfortunately, is not that long lead for business hotels anymore. You get short lead businesses. But what we call business on books or pace or trends that we are seeing remain to be in double digits for this year over last year.
Is that the kind of growth we should expect? Double digits, mid-teens kind of a revenue growth? Because Ashish, as the company expands in size, even the absolute revenue growth has been coming down. So while Q1 was about 10%, last year 18% revenue growth, FY24 was a 30% revenue growth. The year before that was more than 100%. I get with size, it's harder to keep growing at the same rate, but what are we looking at for FY26 and FY27? A mid-teens kind of a revenue growth, is that the sustainable run rate?
Yeah, so let me clarify. For an acquisition-led company like ours, the base that we inherit for the previous year always sets the tone for the headline number, right? Therefore, we've always highlighted same-store growth, and our guidance on same-store growth has always been between 9 to 11%. But then we have some new inventory coming online this year, as in some large hotels, and combined impact of same-store and new inventory will help us deliver about a mid-teen total revenue growth.
Mid-teens, okay. Can you tell us a bit about your pipeline expansion for this year and next year?
So we've already launched a few hotels at the beginning of this year, and hotels do take a quarter or two before they start stabilizing. So we have a new hotel in Calcutta which opened a few months back. We've got a hotel in Greater Noida which got rebranded and has reopened, so that's ramping up. Around October, we opened new inventory in Hyatt Regency Pune and Sheraton Hyderabad. Plus, we have a lot of work going on in food and beverage, so we have some ballrooms under renovation. So H2, we expect to really see the impact of all that inventory addition reflect in our financial statements.
Okay, all right, Ashish, couple of quick questions. The debt number has come down post this GIC deal. Current debt, and where is it headed for the full year? What kind of finance cost savings would be there?
So that's where I think I like to believe we're delivering ahead of our promise. After we had concluded the GIC transaction, we had indicated that we target coming below 3 times at the end of FY26. Happy to say that we have come down to 3.0 as of today. So the path towards going below 3.0 is really almost there for us now. So I think that's one really good momentum. And I think we've articulated our strategy to recycle capital. People sometimes think it's selling. Actually, it's not selling. We need to make sure that our capital is in assets which give us the highest returns. So we expect to accelerate our journey towards the intended path of 2.5 times net debt to EBITDA. We've always said that because we can access 12 to 15 years financing, 2.5 times net debt to EBITDA is extremely, extremely safe zone. And I think I'm happy to say that we'll be there much sooner than we had expected ourselves to be, both because of good earnings growth, two, because of the capital recycling, both what we did with GIC and also the single asset level.
Okay, all right. And one of the reasons that the company wasn't getting the multiple was because of the debt in the books. Now you're addressing that, and that's why the stock has perked up. It started outperforming actually in the last few months. That said, any other deal with GIC, any kind of value unlocking that you're looking at? And is there any kind of, any hotel that you've, marked that maybe you want to get rid of it? So any deal with GIC and any hotel that you want to sell?
No, so the intent with GIC is clear, and it's communicated that we want to create that to be a very large upscale platform. We still have a few more upscale hotels which are in, let's call it Samhi. And I think at the right time we may discuss with GIC, subject to their agreeing, transferring one or two more assets to that joint venture. But that will largely be to really ensure that that platform is well funded for a significant growth in future. So answer is absolutely yes. We will keep evaluating, what other assets we can transfer to the joint venture, recycle our capital. I must say that we are getting some really exciting opportunities for deploying capital. If you see over the last 2 years, we've sold assets. If you look at GIC monetization, about 750 crores, single asset sales about 200 crores. We have monetized about almost 1,000 crores. And at the same time, we've committed about 1,000 crores in new capex. So all we are doing is making sure that, for instance, our asset sales have been at about 20 times EV/EBITDA average. And wherever we're deploying capital is at almost 15-16% NOI yield. So it's a big shift in how the returns will stack up in future.
All right. Wish you all the best, Ashish, and wish you a good season as well. Thanks very much for joining us here. That's Samhi Hotels in focus there.